Hello, everyone. I'm Jeff McCracken from Bloomberg, and today we're going to talk about M&A. Thankfully, we have three people who aren't just knowledgeable about M&A, but at least two of them are in the middle of or just finished very, very big deals. To my left, we have Matt Furman, who's General Counsel at Willis Towers Watson. Next to Matt, we have Kristen Prohl, who is Chief Regulatory Counsel for Starwood Hotels. And then next to Kristen is Michael Aiello, who runs the M&A shop at Weil, Gotshal. Matt, I'll start with you. I know you don't want to be the first person, but walk us through. I think you were pretty new on the job when Willis and Towers Watson started talking about a deal, which came together last year, roughly a $8-point-something billion deal, bringing together two of the largest firms in your space. Walk us through how it came together and tell us what you can tell, how it all played out.
Sure. So on my fourth week in the job, I found out about the deal, and that's really when it started. And so my first thing was to pick myself up off the floor, and then the next thing.
When you say you found out about the deal, what does that mean? Like the CEO or someone came to you and told you?
Yeah, I mean the management team was told that this was a possibility, and we were being brought in to help evaluate whether that was something that we should pursue.
Okay. And what can you tell us about the deal? Anything?
Yeah, I mean, Mike and I worked actually very closely on the transaction, and there are tons of twists and turns in the transaction, a lot of which are well known. But to me, it really proved the advantage of having a counsel that is, especially in a situation like that, that can help anticipate the concerns that you have as the in-house lawyer and can help you solve them.
Kristen, you're in a similar situation. Now, your deal is not closed, right? Starwood is selling themselves to Marriott. It's roughly a $13 billion deal.
That's right. So over the course of the transaction, we did get a topping bid that came in that increased the overall merger consideration. Now we're just over 14 billion, 14.6.
And tell us a bit about the topping bid, because that alone was quite interesting. That was a Chinese firm, an insurance company, as I recall, Anbang, came in and seemed like they were really serious, and then a week later they were gone.
Yes, it was a bit of a roller coaster ride, and it certainly was personally interesting to be part of a transaction that is as high profile and sort of interesting. I think it raised a lot of sort of hot issues that are in M&A right now. For example, just having a topping bid that comes in so late in the process, that was very atypical for M&A transactions, I think. And then secondly, the presence of foreign buyers coming into M&A, as well as certainly Chinese buyers coming into M&A, raising the considerations of a CFIUS review and sort of additional regulatory review processes made it quite interesting. And then of course it was just this rather electric 2-week period of bids coming in from Anbang, then being topped again by Marriott, and having yet another bid come in from Anbang. So, and as you noted, as sort of quickly and surprisingly as they had come into the process, they also left the process, and so that was quite atypical as well. But it certainly was an interesting ride, and ultimately led to greater value to the transaction to Starwood shareholders. So at the end of the day, I think Starwood shareholders are certainly happy for their participation in the process.
Right, Marriott might not be quite so
That's
happy
right.
that they had to bump their bid. But so, Michael, you're, thankfully for you, not in the middle of selling your firm or your firm acquiring.
Not as far as I know.
Yeah, there you go. Hopefully they would tell you.
But Matt didn't know either for a couple of weeks.
But walk us through, I know, for example, you were on the Dow DuPont deal. Could you walk us through that one? I mean, that was big. Those are names everybody knows. That might have been the biggest deal of last year, and I know it still hasn't closed yet, but what can you tell us about it?
I think what we experienced in Dow is I think, a lot of what makes M&A exciting and challenging for me as an outside lawyer, but I think in particular for internal lawyers and business people. For me, M&A is what I do. It's my core competency. That is my job. For a lot of our clients, and I try to have our lawyers remember this, that they are trying to do the M&A transaction, whether it's the Starwood Marriott, whether it's Willis Towers Watson, Dow DuPont. they're trying to do that deal and continue to run the company day to day. And in fact, however difficult it was to run the company before the deal was announced, it gets even more difficult because people are distracted, they're worried about their jobs, the market is all over them, the management team is distracted. So I think Dow DuPont, like any other transaction, is difficult in that it's all-consuming, and life doesn't stop. You know, the company needs to continue to do what it's doing. There are regular board meetings. There's a lot going on. There's litigation, and you know, it's sometimes we'll sit around after the deal, and you'll talk to the general counsel. Okay, what are you going to do now? And he said, in the case of Dow, he'd say, I'm going to focus on the things I've been ignoring for the last 14 days while I've been sitting in your office. So I think that's one of the things about M&A that I try to remind our team, that although it's what we do, for our clients, they got lots of other things to do. And for many of our clients, they're not M&A specialists. That's not what they do. And so we have to help them through that. I think the other thing that makes M&A both exciting and challenging, and Dow DuPont is a good example, is just how quickly things are done. I mean, that was a over $100 billion transaction where we got together in my office on Thursday and didn't leave until the following Thursday, really Friday morning, and got everything done. I mean, you know, and some of you may have been through this, you know, picture an entire conference room floor taken up, you know, 15 conference rooms, people in every conference room doing diligence, negotiating back and forth. And if you're trying to do a deal that quickly, you have to co-locate. You have to really get in the same room. And that's challenging. It's exciting, but it's also challenging.
Why were you in that deal? Why so quickly? Was there something going on externally? Were you worried about leaks? I mean, what was the rationale for moving so fast?
Yeah, again, I think there are two reasons, and this probably drives a lot of what's going on. Once you decide that a deal is going to be done, it's my sense that, you know, time doesn't help. Okay, and so if you've decided this is a good deal, particularly a strategic transaction, and you've done your work and you can get things done within whatever time period you have allotted, it just doesn't get better with time. Okay, and so that's the first reason. The second, the deal did leak toward the end, but that didn't drive us to do the deal. In fact, you know, the deal leaked. I think we talked about this on a Wednesday night, and we signed on a Thursday night. If we weren't ready, I think actually the market didn't expect that we were going to sign until Sunday night and announce Monday. So, you know, if the leak would have happened 2 or 3 weeks earlier, I think it could have been disruptive. And so you want to try to get the deal done quickly, primarily because of the momentum around doing a deal, and at least my view that things don't get better with time. I think also the risk of leak, and the biggest problem with a leak is not that you'll have an interloper come in, because if that happens, it can happen before or after. But again, going back to my point in response to your first question, M&A is so disruptive to companies that if it leaks and you can't even go in and tell people what you're doing, just imagine how disruptive that is.
Kristen, could you walk us through a bit with Starwood? How did that process go? Were they public about the fact they were looking to sell themselves? As I recall, that there was an announcement that we've hired a bank and we're going to explore options. Is that right? And if so,
exactly
why did
right.
you go that way?
Yeah, so ultimately, I think this is a time for a lot of companies where there are activist shareholders, and like lots of other companies, Starwood was, you know, a company that had some activist shareholders. I think out of that process came a decision by the board to make a public announcement that we were considering strategic alternatives. And I think at that point they were very vocal, and we were extremely vocal that everything was on the table. We did go through a sort of a relatively long process, I think, for a lot of people's standards. I think we ultimately signed with Marriott in November of 2015 and had announced that we were considering strategic alternatives, I believe it was in February of 2015. So there was quite a bit of time there where there was the ability to talk with a number of potential suitors and consider lots of strategic alternatives.
Was it a big distraction from that February till November, you know, knowing the company was on the block? I mean, did you have to spend a lot of time to tell the people that you work with, like, we got to focus, even though, you know, there's this uncertainty out there?
I think there's always a natural disruption. One of those things are there. I think that it's challenging to, you know, consider what are the biggest goals for that year when there's something that is that distracting that's going on. I think we additionally during that time period we had an interim CEO, and we're looking for a CEO, which is certainly a challenge during a time period to bring on a CEO when you're in the middle of a strategic alternative search. So there were a number of different work streams that were going on, and in addition, we were in the middle of leading up to this point, which was another pretty significant transaction for us. We were spinning off, and then we ultimately restructured to a sale of our timeshare business. And just closed that transaction a couple of weeks ago with ILG. That transaction was underway. So, for a company to have 3 or 4 major sort of avenues going on at once, just naturally, that there was, I think,
So
a lot
you were
of
a little
activity.
busy?
Yeah, it was very busy, certainly.
Matt, I think you said you have roughly, 350 people that work for you or that are
Yeah,
the general
including
counsel?
the compliance folks, that's right.
So in a situation like the deal, how many of those people would ever be looped in until the very end?
So for the reasons Mike was saying in terms of trying to prevent leaks, we made a decision, both companies made the decision to keep the deal teams very small. So I was the one out of the...
You were the one of the 350?
Yeah, until about maybe a week or so before we signed, and then we expanded the field a little more. But that, of course, it led to some interesting situations where, as the new general counsel, who's now responsible for reps and warranties and schedules and so on, I'm now asking questions, detailed questions of people around the world and getting copies of agreements, and they're wondering why the new general counsel is, is the most nitpicky guy they've ever met. So.
You work on, I think we were talking the other day, that you work on a lot of public and, well, not public, but also a lot of private deals, right? I mean, how many deals at in any given point in time are you managing or overseeing? And are the private deals always easier and simpler than a public deal, or not so much?
Yeah, I actually think the complexity of the deal doesn't always reflect the dollar value or whether it's public or private. We're in 120 countries, and while we had a similar situation doing multiple deals at the same time, we did a very large acquisition of a French broker, the largest broker in France, with operations in dozens of countries. And so it was quite a bit of change at the same time, and all 2 transactions closed at the same time, so it's a 3-way integration that you're working on. So this has been an all-hands sort of activity, but I'd say we do maybe 4 or 5 transactions or potential transactions are going on at the same time, but some of them are maybe small and some of them may be joint ventures.
Okay. So, and there's a team within the 350 or so that focus on M&A?
Focus on M&A and then bring in the rest as necessary.
People like Michael or someone to the expertise.
Yeah.
Kristen, you'd mentioned the spin-off. So what was it exactly that you spun off, and could you tell us a little bit about either the complications or the hurdles you had to jump through to complete that deal?
Well, we just completed the sale of our timeshare business, which was Starwood Vacation Ownership, and has been rebranded through the process to Vistana. We had originally started the process in 2014. I remember.
Were you going to IPO it and then you changed your mind, basically?
Well, we were doing a spin-off of it. So yes, it was going to be a new public company. About 6 months through the process, the board decided, well, let's consider our alternatives at this point, and we're going to put it out to bid. We started an auction process, which went for several months, ultimately downsized to 2 competitors, and then a number of months later announced that we had signed with ILG. And then there was roughly about a 6-month process between signing and closing. And so the complexities of having done that is not only were we going from trying to take a business unit and have it stand up on its own as a public company, certainly with my team's responsibility, there was a number of SEC filings, there were antitrust filings, there were all these things that had to go on in the spin-off context. Then dual tracking that, again, without anyone knowing that it's going on. The sale process, then almost third tracking it down when we had downsized to 2 competitors without the other people who were buying knowing about that. I mean, there were so many layers of complications through the process, but ultimately it was a really fascinating transaction. On the other side was actually Weil that we were working with, and it was a transaction that was going to a buyer who did not have this particular business unit. So in many ways, it still brought some of the same complexities that a spinoff would, because they really needed on day one for this business to be able to stand up on its own.
So you guys are all in the middle of, major consolidation that's going on either in your industry or across a bunch of industries. I'll start with you, Michael. Why it seems like roughly the last 18 to 24 months we've just seen a series of incredibly big consolidation plays. You mentioned Dow and DuPont. The two of you were both in, moves that would fit that. We've had healthcare companies, U.S. health insurance companies that have merged. Pfizer tried to make a big consolidation play, which obviously didn't pan out. Why now? Is it because 2% GDP? Or, what are your thoughts strategically? Why all this consolidation? And Michael, I'll start with you.
Yeah, I think it's probably three reasons. I think the first is that growth is difficult, particularly in a lot of the industries in which you're seeing transactions. And for as complicated as M&A is, it does enable companies to grow. And I was just having this discussion last night with one of our CEO clients who's very acquisitive. And now, notwithstanding all of what you hear, M&A at the end of the day actually does generate real value and growth that's probably not achievable organically. And I think that's really the primary reason. I think the other reason is defensive in some sense. And whether it's activism or some other external force, there's a lot of pressure on companies right now to do anything. And maybe it does feed back into growth, and this really is an avenue for growth. But I think there are external pressures on companies. I will tell you that most of my engagements with respect to M&A are new clients. They're people who will come and call me to help with an M&A transaction, and it's a client that I didn't have a prior relationship with. A good number of those are derivative of activism. If I go back and look at the number of the things that I've worked on over the last year and a half, 2 years, it all started because somebody got in the stock and either had a good idea or a not so good idea, but they were agitating, and it led to M&A. I think the third thing is that people are doing it. And I think there are boards looking around. If you're in the pharma space and everybody's doing it, and a board naturally says to the CEO at a meeting, why not us? Why aren't we doing it? So I think it's really an accelerated path to growth that if integration is handled right, while it's a distraction, it actually can deliver real growth. I think there are external forces, not just activism, but external forces that drive M&A. And I think for companies, particularly strategics, because you're not seeing as much private equity-driven M&A. You're seeing a lot of strategic to strategic. We saw more merger of equals over the last 8-10 months than you've seen in years before that. And I think it's just companies looking at other companies doing it and wondering why they're not engaging in M&A right now.
Kristen, what was the industrial logic for Starwood and for Marriott in that space?
Well, I think it's very attractive to be able to say that you've created the largest hotel company in the world. I agree with everything that Mike has said. I think that there are, lots of reasons why being able to bring scale to your business is very attractive. And through organic growth, you can never get to the same types of numbers that you could through a transaction of this size. But I also think where you had started, honestly, the cheapness of debt right now. I think that Marriott is someone who's using debt to purchase Starwood, and if rates were at a different place, maybe they couldn't have been able to make that type of move.
Right. Matt, what was the strategic rationale there?
There were a number of synergies that we saw coming from the deal. There were certainly cost and tax synergies, but the biggest by far were the revenue synergies and the fact that we were in complementary businesses. So Willis very strong in the insurance brokerage space, deep relationships with middle market, say in North America. Towers Watson, the oldest actuarial firm, the largest employer of actuaries in the world, and very, very strong relationships with the largest companies. And so the two together are that much stronger and help us serve our clients better.
How is it seems to me, just as a journalist, that the last year or so, maybe year and a half, we've been spending a lot of time focusing on DC after these deals get announced, because a lot of deals have either been, again, with Pfizer, where it was blocked not by regulators but by Treasury, but then a lot of deals blocked by regulators, Halliburton and the office
Staples.
Staples. I'm kind of curious, Matt. How big was the regulatory piece, or how much concern did you guys have about the regulators and the questions they would be asking?
So our big regulatory piece wasn't in the U.S. It really is in other markets around the world, and we're regulated. We have 150 regulators around the world, and so it was more. It wasn't anyone in particular. It was the collective weight of that, and the fact that you're subject to the slowest of the pack. And so I think a lesson learned from that is you really you can't start too early on that.
How many
process.
How many law firms did you have working on the antitrust, just the antitrust piece?
Yeah, I mean, there were the two major law firms
Okay.
that were doing the antitrust piece, and it wasn't, because we were complementary, not overlapping. It wasn't a very complicated one.
Got it. Kristen, I mean, was that an issue for you?
Yeah, we're still in the middle of our antitrust process, so I can't speak too much about it, but we have had to file in over 30 jurisdictions, and we still have a couple of jurisdictions that are out there. So it's a major process, I think, for any jurisdiction, and it was something that we had to look at very closely up front, frankly. With an M&A transaction of this size, you have to look at the global jurisdictions and to make sure that this is something that really can be done.
Michael, I mean, any deals of yours knocked to the side in the last year and a half?
Well, I represented Staples, so it's probably not a great time to talk about it. But Staples and Office Depot. I represented Iron Mountain, where it took us a year to close the acquisition of Recall, which was a complementary business based in Australia, but both companies had, a global business. The only thing I'll say, and I think to pick up on what Kristen said, I don't believe these things sneak up on you. If they do, then you haven't hired the right management team, the right counsel. These shouldn't sneak up on you. I do think, as Matt said, you need to spend time up front because although we have focused on the time between starting and signing, probably the most disruptive time is the time between signing and closing. And so, the regulatory process in the U.S., if there are some issues, and outside the U.S. could take some time. So I think, I really don't believe these things sneak up on you. I mean, regulators may have different views than you anticipated, but I think on the margins, if you look at these deals, and I'm not going to comment on Staples other than to say there was a $250 million reverse break fee. So this was something that people were talking about, okay? I do think you need to spend the time up front, and sometimes, as I said, when these deals get momentum, all of us, whether you're in-house or an external lawyer, we have to put our hands up. And so you have to raise these things early, make sure you spend enough time not only analyzing the issue, but coming up with the plan, both the plan for dealing with the regulators and the plan for communicating to all the relevant constituents, okay? The relevant constituents are not only your employees, but they're your customers and your suppliers and your vendors and your competitors, because those are the ones, particularly outside the U.S., that the regulators are going to hear from. So I don't know, I mean, we could debate forever and whether the regulatory landscape has changed, and who knows what's going to happen, come the election. But what hasn't changed is that we all have deals that are subject to regulatory review. You have to spend time up front working through that.
You rely on President Trump to fix things.
As I said, who knows what's going to happen.
But what's interesting, I was talking to some bankers about this recently, and they said one thing they're doing now with clients when they're at a situation where the deal makes sense, but there is some antitrust risk, is they'll come up with a plan of like how to handle things, basically how to slow integration down, which isn't a positive thing if the deal gets done, but they think sometimes that's the best answer for the clients if there's a risk of a deal being blocked, like whether it's Staples or Halliburton or what have you. Did you have a?
Yeah, again, people talk about what you're going to do. At the end of the day, as a practical matter, you have to plan to complete the deal, okay? Even when you're getting close to the end, it's hard enough sometimes to get a deal approved, whether it's by shareholders or by the regulators, if everybody's working really hard and rowing in the same direction. As soon as somebody goes off track, I think there's a multiplier that you need to think about in terms of the detriment you've done to a deal. So I think people are always integrating within the bounds of the law, because even when you get your regulatory approvals, there are constraints around what you can actually do. I don't really see people slowing down, and I don't see a lot of contingency planning down in the trenches. At the board level, at the executive management level, with your outside counsel and even there, only the outside counsel that you would truly consider your advisor, are you thinking about contingency planning? Among the team, there has to be this notion that we're driving to closing. There's a timetable. Again, I haven't worked with you, but I worked with Matt. There are detailed project plans. And so if you were to talk to the team, they're not even thinking about the FTC or the Department of Justice. All they're thinking about is the project plan, which drives them to a closing. So I don't really see people slowing down. Look, when you get close to the end and you start real contingency planning, then you're planning. But even my sense, at least in my experience, is that even that remains at the highest levels.
Real quick, I maybe a couple more minutes, and then we'll look for some questions. Matt and Kristen, what are you looking for from an outside counsel? I mean, what do you, besides expertise and good value, what is it that you want from outside counsel? Matt, I'll have you start.
Yeah, I think you're looking for ownership as much as anything. I mean,
They feel the deal is as much theirs as it is
exactly
yours, if you will?
the image that maybe you don't want to think of is your counsel in the showers thinking about your deal as much as you are, and is really proactively trying to flag the issues that you need to deal with. Because as inside counsel, you're dealing with a flood of information, and what you're trying to do all day is to pick your spots, pick those issues that need to get resolved or highlighted for your stakeholders. So,
Kristen?
I think from my point of view, it certainly is that partnership with a trusted advisor. I think that on top of, there are a lot of people who have expertise, and sometimes a challenge as an in-house counsel dealing with outside counsel is having a counsel is really willing to say, this is what my recommendation is, rather than just laying out the risks. And so when you have a relationship where you have a trusted advisor and you can have more of that sort of deep dive conversation about not just the risks, but what's the next smart move as a result of those risks, I think it really takes it to the next level.
And Michael, from your standpoint, what are you looking for from the client when you're on a big deal?
Again, and this may be informed by what I said a couple minutes ago, which is I often get hired by people who are not my clients. Expectations, and Matt, although I had been working with Willis, I hadn't worked with Matt, and when Matt got hired, I didn't assume that I would be working for Willis. I thought this is a general counsel who should come in and pick his or her team. And so I wanted to make sure I understood, what are you expecting from me? How do you like to interact? The personal part of it you have to develop over time. But I think that with our clients, just knowing what they want, setting expectations, making sure that I know what they're looking for in terms of work product and timing, don't anticipate stopping. I'll often stop after a week or two or three and say, how are we doing? And while it's nice to get pat on the back, and that's half the reason why I probably asked, the other half is to really learn whether we could change anything in the team and so forth. So I think for particularly when you have somebody like me that may be coming in for a deal, sit down and say, look, I'm not going to be able to think of everything. However, here are 5 or 6 things. Some of them are quirky, it's just me. Some of them are things that my boss is looking for. Expectation setting, trying to understand as much, and open communication. If something's not going well, let's talk about it, because if it's not going well in week 1, by week 10, we're not going to like one another, and we have to really lock arms and get the deal done together.
Got it. Any questions from the audience? If so, raise your hand. We'll bring a microphone to you. No? Okay. I have a couple more then for you. How are you dealing with cost pressures as it relates to the law firms? I mean, are you stepping up, if you will, the scrutinizing of the bills? I'm just curious. Has there been anything that's changed for you?
Yeah, well, I mean, we're as a new combined company, it's an opportunity for us to have new conversations with those that we work with, and to make sure it's not just cost, it's value, and making sure we're getting the value that we're looking for. And so that is actually something we're looking at now. And when you combine, you go from having X number of firms that you work with to 2X,
right?
And there's something less than 2X that
inevitably
is
someone probably gets.
And so, but it's an opportunity to level set again with your counsel, understand, what they can bring to the table and what you're looking for. And so that's what we're doing now. And unquestionably, I think so many people in my position have cost pressures. That's what happens. Low growth, low interest rates, low inflation.
Right.
That's going to be margin pressures on business, which is we're going to feel it too for all the right reasons. So.
Kristen, any thoughts on that?
I agree. I mean, I think that every public company, everyone's always looking at SG&A, and things like outside legal costs go right into that number. And so there's always pressure to make sure that you are using outside counsel efficiently and wisely. I think there's a lot of pressure for in-house counsel to take on, a large amount of some of the work that might otherwise in past years due to the increase of outside counsel costs over the years, to bring some of that work inside and really use outside counsel as an expertise role. I definitely see, and we've done it over the years at Starwood, a number of RFPs, looking to consolidate who we use as outside counsel. So, naturally over time, you might see this growth in terms of which firms you're using, and then sort of this restriction of going back to one or two primary firms in order to leverage particular pricing details. And then within the last couple of years, probably now about 5 years ago now, we did do an outside counsel billing policy as a way to try to reduce costs overall, but really to the point of establishing value. And I think what Mike said, making sure that we were clear in a policy for all of our outside counsel that laid out what our sort of fundamental expectations were, so that there was a meeting of the minds about what we expected for the value being received.
So my last question, very journalistically focused, how do leaks and how do the media impact deals? Mike, I'll start with you. You mentioned Dow DuPont leaked a couple days before, but any situations where something leaked and it killed the deal or made it much harder?
The biggest issue with a leak is that it brings another party to the table. It's hard enough trying to do a deal with a counterparty. Right? These deals are complicated, as I said. They're fast-paced. Even with your deal, if you think about the size and the complexity, to even do something like that over the course of a couple of months, it's a challenge. And now there's a leak, and all of this external pressure, this third party that will bring to bear, because you get a leak in investors, and then
third and fourth and fifth parties, right?
Right,
Because now
ARBs move into the
employees
stock, and
ARBs
activists move into the stock, and your competitors are calling around, and customers are calling around, and your employees are panicked, and they're dusting off their resume. So I think the biggest problem with a leak, and there's one last thing, but the biggest problem with the leak is the disruption that it causes, and it takes a deal which is incredibly difficult to begin with and makes it more difficult. The other thing, and it shouldn't matter, but it does, is that if it pushes the price up and the premium evaporates, I hate to be the guy in the boardroom to say, you need to look at the fundamental valuation methodologies, and that really drives whether or not this is a good deal. And the director said, but it's still a zero premium, and I'm not going to be the guy or the woman who does the below market deal, even though I have 4 investment banks that are credible putting this forward. So that's the big issue with the leak.
Got it. All right, we are running out of time. Hope that was interesting for everyone. Thank you.
Thank you.
Thank you.
Thanks.
Thank you.